All right, so we have a very special guest with me today. One of my favorite guys to talk to in the car share insurance space. We've got Edward Walker, who is the U.S. Shared Economy Practice Leader of Hub International. It is the largest private insurance brokerage in the world. Ed is based out of Los Angeles. How you doing, Ed?
I'm doing great, Alex. How are you today?
Great, man. Thank you so much for your time today. I always love talking insurance and talking shop with you. As you know, I refer a lot of people to you because I always trust your judgment when it comes to the insurance space. Today, I really want to talk about the LULA Insurance fallout. I know you have a lot to say about this, and let's kind of just jump right into it. Obviously, LULA was covering period zero ORP, off rental protection, for car share fleets. And this was specifically insurance designed for car share hosts and fleet operators who were basically just trying to insure their fleets for when they were on Turo or Getaround. I know this has kind of imploded in the industry. Tell me, what are your thoughts on this right now? How is the fallout affecting the industry? I'd love to hear just, where this is all going right now.
Yeah, of course, Alex. And like one of the big things I want to highlight is, I think theoretically the model started as kind of like a P0 or off rental platform coverage. And I think maybe the platform lost sight of that a little bit, or candidly really just wanted to start that off as a, use case for the beginning of their model. Because, I'd say their offering probably spanned the course of 3 to 4 of the past years, maybe 5. And during that time, I saw them with a number of various different makes and models within the shared economy landscape. So that's just regular owned vehicle rentals, rideshare rentals, P2P. I mean, I wouldn't necessarily say their use case is that focused, but I see their offering really having touched a lot of different corners of the shared economy kind of landscape. Now we fast forward to today. So I'd probably guesstimate that, maybe between 15 to 30%, maybe more of the entire community, including some of the larger, brand name operators in the space that were using LULA for a second there. I'd say, fast forwarding to today, with their departure from the marketplace, what this has done is a lot of things. So this isn't just a simple carrier exit, in my opinion. This has very far-reaching implications. And this, you mentioned the insurance landscape, which I think is important to discuss because, what you have within the lens of the shared economy fold is really probably 4 to 6 tried and tested A-rated carriers, been doing the business for a steady amount of time. Some of those backed by, your absolute blue bloods of insurance, very long sweeping offerings. They're not going to go anywhere. They offer great price stability. Those prices might be somewhat inflated when you take a look at your LULAs or, any number of the other, quite frankly, kind of, I don't want to speak too off the cuff here, but sort of gimmick programs a little bit, because what you really develop within the marketplace with that is a couple of items. First and foremost, you set a unreasonable pricing expectation with your customers. So what I saw from a lot of legacy rental operators, rideshare, even startups was really, if it's a startup, they're getting started on the wrong foot. So they're developing really bad habits that are not being corrected in the early days. So not only do you have an operator that's operating on, hey, this insurance is actually really, really competitively priced, and all of the rules, regulations, guidance I'm usually supposed to be adhering to within this model, I just no longer need to do. Or in the case of a startup, we've never known it was something we need to do, so we're just going to hand this all off to this entity. In this case that we're talking about, LULA, and we're going to have them handle it, and we're going to develop our operation and kind of take our focus away from the insurance. And I think that's a big issue here that I've noticed within this departure is many of the operators I've spoken to from a very basic risk servicing level, and by risk servicing for your listeners, I would say are things like, rental contract review, make sure it has the right, particular bullet points, so on and so forth, disclaimers, rules and regulations, guidelines, so on and so forth. No racing, for example, like if you're renting the car, that's, a very simple example, but there's more detailed there. Additional items would be running background checks on drivers, MVRs, particular percentages of, in the rental car space, for example, there's a legacy underwriting model that has a certain really volume breakout of individuals who are traveling from outside the US without a driver's license versus regular US rentals. There's just kind of a bona fide expectation a lot of these carriers have. And these are just a few of the rules or guidance or, just building principles that none of the LULA customers had to adhere to. It was really just, hey, here's your policy, best of luck. Take it for what it's worth. And again, the risk servicing part of my job, I think, is one of the most important pieces, because we're in a market right now where claims are largely outpacing premiums. We could go down a rabbit hole on a couple different levels here. I mean, you sit in Florida, which is a state that's probably more guilty than most of a lot of these.
Yes.
But what you have with risk servicing, like, this isn't just a carrier saying, hey, you got to do X, Y, and Z. You just have to do it, and we want you to do it. They're asking you to do these things because they are proven methods to reduce loss. Bottom line. And by the way, that's, whether some of those are too far reaching or not is on your broker. And that's something an insurance broker you work with should be able to communicate with you. Something I talk through with my clients all the day. Let's give the carriers what they need, but let's not overextend ourselves here where we don't need to be sharing or we don't need to be building out a system without talking about the considerations involved. And I think pulling that all together, one of the big issues is, especially when I see a startup company that started with a LULA or something similar and now is being non-renewed or canceled, and they're sort of waiting and trying to do their best to replace that coverage, is, hey, we've got to take now extra time with your risk, with your operation, to make sure we're doing kind of the very simple things correctly. Because again, when I said it earlier, I want to really reiterate, like, the reinforcement of bad habits is what a lot of times happens here. It's not just, hey, it was super cheap. It's also, we've found some accounts, or we've got, some drivers that we're renting that have, 6-7 points on their driving record. I mean, like, very simple, in my world of insurance, and this could differ from an insurance opinion, but very simple, over the road risk management techniques that are just not being adhered to. And a lot of this is just ignorance. Hey,
Yeah.
we signed up, they said they would do this for us, no big deal. And, I think a philosophy I like to imbue on my clients in the space is autonomy. We're only as good as you are from a risk management perspective of your own operation. If you don't know your own policies, principles, over the road guidance, maybe even telematics, driving behavior, if you're not on top of these items, it makes it really difficult for you as a business to pivot and move within the marketplace as it is. You're kind of starting from the wrong spot. So, I see this as a really big vacuum of knowledge that has not been bestowed upon many of the rental or car share community, because it wasn't required for the policy guidance within, in what we're talking about today, which is LULA, which, when we jump in, we have to reset all these expectations. So it's not just a, hey, we got to do X, Y, and Z. Hey, we got to have a lawyer review your rental contract. Hey, we've got to start, actually pulling MVRs on each and every renter. It's also, moving into some of your other points here, the insurance carriers that have been writing this for, if it's just a regular, Joe's car rental operation, let's even remove rideshare from this. They have been pricing, they've been actuarially developing their premiums for years, for maybe decades with some of these models. And when now I'm focusing a little bit more into your, not so much startup, but into the more, 10, 20-year rental car companies that are they saw this, bright shining star, which was LULA, and they're like, oh my God, we can save money, we can save on overhead, we can save on our day-to-day emails to brokers, carriers, whatever. All of those carriers that lost that business to LULA or similar, MGA programs like LULA are now seeing this void in the space. They're all seeing these customers come back, and, there's not a lot of empathy there, because the message has always been, and quite frankly, this is a message I've always given on many of my clients that have made that decision, was, this isn't going to last. And this, I have developed to a point, Alex, in my career where, listen, I'm always out for getting my clients the best deal. Like, you know, premium is always important and you can never discount that. One of the items I'd say I bring to the table is I can eyeball at this point in time in my career where I think it's very clearly obvious that a carrier is going to be losing money in a geography based on an operation. And do I place some policies today with some A-rated carriers that might have what we call negative capacity, which means that the insurance carrier is most objectively writing this business at a loss, at least for 1 year, maybe two, maybe they're, you know, you could come up with a lot of rationale for it. Okay. But I, you know, and I have some markets today that I still feel are in that ballpark. And I tell my clients, listen, I don't think this is going to last. We can choose this option, or we can choose the 10 or 15% more option where we're going to have pretty much a guarantee of stability and year over year, you know, partnership with the carrier versus, you know, a very fragmented, could be non-renewed midterm, could be canceled midterm, could be re-rated midterm based off of loss history. I mean, the volatility is so considerable. If I'm ever going a direction where I see a price that I think might be too good to be true, I will always give that disclaimer. And I always have when I've been very familiar with this program and ones like it for you know, the past 4, 5, 6 years. And my message has always been like, you know, farewell and good luck. You know, give me a shout back when this thing falls apart. And by no means am I wishing for it to do so.
Yeah.
You know, I've just gotten to the career where reality and, you know, rational minds usually prevail. And when you're not pricing auto liability for the right amounts in this environment of nuclear verdicts and, you know, $1 million claims that can happen at the drop of a hat, not to incite any fear in anyone, but it is the reality of the situation. You know, going into this thing, you know, without a full dedication and vigilance about what you're doing and who you're partnering with as a carrier perspective and the coverage they're providing is really misguided. And these carriers that have been here in the space through this entire up and down of the LULAs and other programs, they all know the decision-making process. And what unfortunately this has done to many operators is not only put them in a little bit of a resentful place from some of these legacy carriers, which is cultural, and like you can tell them to, you know, screw off for that. But what it's also done, like I started the conversation with, is even if they weren't a startup, maybe they were a, you know, a 10, 20-year rental operation, their policies and procedures on average have dipped. They've sort of lost focus on the program, sort of handed it off to somebody else. And the very typical conversation I have is, you know, we got to get back into this thing, man. We got to roll our sleeves back up and take back control of your insurance. If you want to come even close to the pricing methodology we had, you know, before that or with LULA, in order to really appease the underwriting side of the table. Because, you know, what do these underwriters know? They know everything I just told you. They know that you didn't have as many responsibilities under the policy, and they're now expecting that to be the case. You know, one clear.
So
go ahead.
So let me ask you, you know, so obviously what I'm hearing from you is that LULA was complete fantasy land.
On a lot of fronts, mainly pricing, but on many other fronts as well.
Yeah. So I think, you know, the challenge with this is that, you know, in this industry, we have kind of two classes of operators, right? We have the 5 or 10 car fleets or more who are a little more experienced, or I'd say, you know, 10 or more cars in their fleet. They're a little more experienced. They know this business. And, you know, they're thinking, oh, great, you know, $90 a month. Awesome. I can just cover my period zero and I'm good to go. And I would say, you know, those guys are probably a little more knowledgeable about insurance and really kind of understand the nuances in this space. Then you have this classification of car share fleet owners who are under 5 cars. That is the vast majority in this industry, by the way. So, you know, like on Turo, 80% of their operators have 1 to 2 cars. Probably a similar, you know, maybe 90% on Getaround have 1 to 3 cars, right? So there is, as you said, there's a knowledge vacuum about this. And people are kind of getting into this industry thinking this is, you know, cars, like it's like Airbnb, but for cars, right? Now, obviously, you have a lot of understanding of the nuance. I mean, realistically, I mean, are any of these types of products, whether it be ABI period X, whether it be LULA, you know, Romley's got a new product. I mean, is this kind of just like, are all these products bogus, or like, how do we deal with this period zero coverage?
I caution from stamping each and every one of these products as bogus. Just and I'll say personally, like I know a lot of the folks from the Romley team, and they do come from very prestigious underwriting circles. And I quite frankly think that Romley has done a fantastic job with the RV share program. So I think it's a big spectrum of value. I'd say generally speaking, when you're looking at a program, because you know the status quo operator in the space is more than likely not going to recognize a lot of the brand names involved. You know, with some you know exceptions. My point being is that you don't want to just take everything at face value. You don't want to just say, hey, you know, the pitch is great, the price is great, screw it, let's go ahead and do this. Okay, what you really want to do is, and where I think the danger is, Alex, is some of these programs, or most of them, are you can use a broker for them, or you can go to them direct. And I would say the reason I exist, the reason insurance brokers as a whole exist, are to keep carriers honest and to give you an objective opinion about the risk transfer that you are purchasing. And it's important, you know, we have licenses. I won't go say it's like a Series 7, but it's still a license that, you know, some folks, you know, find difficulty providing. So it is a fiduciary responsibility that we provide. And I think when it comes to these new insurtech programs, you know, across the board, you just need to look at them with a little bit more skepticism, because let's say that the offering is valid and the paper is good, and by paper is good means it's financially rated well, which quite frankly is one of the #1 ways to gauge a carrier's ability to pay claims is the financial rating they have. I'd say if you have a program you found and you can't find the financial rating and you ask for it and folks are saying, oh, well, it's you know, you start getting circular conversations, those are red flags. Okay. But you know, I think it really comes down to diligence. I don't want to label them all as, you know, as a gimmick program. Some of them are, some of them aren't. I'm certainly rooting for some of these insurtechs within the, you know, M&D and investment space and insurance to thrive. There's no doubt about it, and there's no doubt that we need that. Okay, we need innovation in insurance, and unfortunately, we're just not an industry that prides itself on that. Unfortunately, we move at a glacial pace, and that just seems to be, you know, how we do things in insurance. Short of what I try to bring to the table, that is just our general status quo in insurance. So I would just say it really comes down to vetting who you're talking to, and, you know, take the extra second to talk and find a good broker who knows what they're talking about, who knows the various periods, who knows the different carriers, the geographies. I mean, every sector of the country has different value adds that can be provided. And you just need somebody with a great knowledge base to be able to really articulate those to you and give you some semblance of confidence behind what risk transfer you're getting. Because, you know, I know a lot of our conversation has been on LULA here, Alex, but what I would circle back to is one of the big issues I've heard. You know, I personally, you know, at Hub, we are not allowed to engage with carriers less than an A-rated financial rating. So, you know, we never really, I had the opportunity to partner with LULA because personally, on my standpoint, I didn't believe it was a adequate product for my customers who were serious about transferring risk. But when you have a poorly financially rated firm, you generally see claim trends not being paid out as they should. And the biggest complaint I heard out of LULA was, I'm not getting my claims paid. Or if I'm trying to get my claims paid, it takes months and months and months for these things to occur. I have to call. It's a 1-800 number. It's not a direct person. It's an email inbox. Those are other layers of red flags to sort through. That's why, like, if I were to give advice to your audience, I would say, okay, if you're entering into a possible contract like this, ask them how the claims process works. Ask to meet their claims representatives. Say, hey, I would love to have a meeting with you and your claims team to walk through what this process looks like. Okay, because a lot of times people just see the price and say, okay, great, here's the credit card, boom, insurance is taken care of, no big deal. And then it comes to a claim situation, and they're like, oh my God, what do I do? And I only know this actually because everybody leaving LULA right now, the #1 biggest issue, short of the items I mentioned earlier, is a lot of them are having difficulty pulling realistic loss ratios. They can't actually pull a loss ratio from, or a loss run from the LULA system without considerable issue, okay, or time. And that's something where if you want to move on to do insurance, it's just like your personalized insurance. If you were to cancel State Farm or cancel Allstate right now and then keep a car, and then 2 months from now you try to apply for new insurance, those companies will be like, what happened for those 2 months? You know, because one of the biggest, you know, arrows in a quiver of an experienced operator is experience. You got 5, 10 years. We want to be able to say, hey, it's a 5, 10-year experienced operator. But if we can't bring in together loss history to back up that narrative, you know, it actually comes to the table that do we even just repurpose your submission as an insurer to say you're a startup? Because otherwise, we're going to have to get into the details of your LULA policies or another program. And are we going to be able to do that? Because without loss history, it's almost as if you didn't purchase the insurance.
Yeah, I understand.
Even if you've had no losses, carriers don't believe anyone. If you flat out say we have no losses, nor should they, by the way. I get it. Listen, we've had no losses. You should know this. Fine. Okay. You still have to submit a piece of paper that says, okay, from the carrier says there've been no losses. Great. That's all it takes. But we still need that, you know, objective proof. And obtaining that can be extremely difficult from any of the programs we've mentioned. But again, I do want to reiterate, it's a spectrum. You know, there are insurtechs that have done a really good job in earnest of trying to tackle the space, and they also didn't succeed. You know, look at Buckle. You know, a few years back, you know, really great sound team, put together a product that the marketplace needed. I don't think they were trying to hide anything. I think they were being very earnest in their administration of it. You know, loss history kind of took control, kind of put them out of business. And so you know, you want to evaluate things on multiple spectrums. And I think it's important to, you know, jump into those various details and to make sure you're making the right decision, even if you're just a couple cars. Yeah.
And, you know, you bring up an interesting point. So, you know, as I hear you talk, I'm wondering, okay, so the car share industry, insurance has been a little slow to catch up to car share. Car share as a technology, as a space, is relatively new. It's within the last 10 years. It's caught fire. As you said, the insurance side of things takes a while to catch up. You know, you mentioned that at this point, the claims are outpacing the premiums. I guess, you know, really kind of the elephant in the room as I hear you talk about this is there an economic case for insurance companies to be made? Can they, you know, be profitable in this space? Can we see, you know, products continue to develop in this space where everyone can kind of, you know, rest easy at night?
All signs point to yes, because throughout my career, and I've been running sharing economy models since 2017. Through my career, the breadwinner carriers of the space are the same carriers that have been there since 2017, writing the same business. Okay, with a few exceptions. Okay, and so what those individuals or companies have done is have developed an adaptive model that's been able to keep pace. Now, everybody on listening to this might not agree. They may have gotten some quotes from some of these companies that said, "What is this? Can't believe it's this expensive." So yeah, I mean, insurance is its own economy. You know, we've got demand and supply, and they do adjust in order to, you know, make room for claim payments, which again, that are, you know, as we go into the future here, seemingly getting worse and worse. You know, there are reports that there are lights at the end of the tunnel, but that, you know, realistically speaking, the programs we've discussed, the insurtechs with broad offerings and broad solutions, super minimal price points, it's just a law of practicality, man. You just got to understand, you know, you get what you purchase. And that might be a harsh thing to say, because I know there's probably people listening who have had pretty nasty situations with that, you know, cause and effect. But, you know, that's, you know, working with me or other professionals like me, we're going to give you those options. You know, the way I phrase it with many of my clients, Alex, is, you know, here's our option for this year. I think this is the best one. This one gives us stability. I think next year's renewal will look better. You know, I'm not just an in the moment broker. I'm a forward looking. If I narrow our customer down to where we want to be, I'm going to give you an outlook of what that renewal next year and the year following might look like. Okay. And by the way, how do we prepare best for those? What new things might we be able to implement so we can even do better next year? Okay. How do we build our resume up in the space? Because what LULA and a lot of their counterparts do in these various programs of you know, and you go to different states and stuff, there will be different subpar rated financial offerings, is they really cause frictions with what I've just described. You know, you've got these stable slew of carriers. Maybe they're charging more. Maybe they're, you know, it's stable over the course of a couple of years. Maybe it isn't, but they're still in the space. When you have these little blips in the radar from, like, you know, LULA, maybe 2018 to 2020, you know, 2024, I think closed their doors, 3 months ago. For that period of time, a whole bunch of premium went somewhere else, okay, with unquantifiable loss history. Because again, even if you can get it, it's really difficult, so it's hard to articulate. That's a whole bunch of premium and loss information that these carriers who've been in the space for a while, that's data they don't have now. Okay, so if you see where I'm going with this, it is an unfortunate distraction from pricing the risk adequately, because people are taking it a direction that has no future. The future for your own risk management, quite frankly, for any operator, is to get to a point where you as an owner, so maybe it's your general counsel, controller, maybe it's the CEO, maybe it's just, the owner of the business. If you don't know and can predict your loss history for your fleet year in, year out, or have analytics to help you do that, you're not investing towards the future. And that's what a lot of these programs do, is they pull away the importance, or they distract you into thinking, hey, I can just, all right, I'll just throw my credit card in auto pay and insurance is now handled. It's no big deal. I don't even have to focus on this. And that's unfortunately a cultural side effect I see a lot. And I'm not throwing anybody on the bus here. I think that's a normal, part of the marketing process for some of these, some of these insurance platforms, is just to say, hey, forget it, set it and forget it. Going back to the old Ron Popeil days with the oven on the 1-800 channel. Like, insurance is something you got to invest in, no matter what, no matter how big or small you are.
Yeah. Let me ask you this. So in this industry, private rentals are getting a lot more popular. This has been a big topic in the Turo sphere. It's also, very much, talked about on the Getaround side of things. Operators are looking more at short-term and long-term private rentals. I know private rentals is like a whole other challenging kind of situation. What are your thoughts on that, generally speaking? It's kind of a controversial topic. I know I've talked to many companies like, Car Putty or Tenet, or, nobody really loves dealing with private rentals, because most people have seen what happened with, Hire Car and a lot of their clientele. So, but it is, when you can, strike that balance correctly, it is very lucrative. What are your thoughts on that?
I mean, I think again, I think this just comes down to just core principles. It really comes down to making sure you're managing, every example we've talked about in the negative here, Alex, has been companies that have let the due diligence process slide. It's absolutely doable. Subscription models are a very new, popular subtopic of this, that quite frankly, it can work as long as you set up the systems for your operation to be successful. Okay, that's capturing the right amount of data. That's running the right amount of background checks and MVRs. That's the right amount of check-ins and check-outs. How are you avoiding, with a P2P model, for example, how are you avoiding the process of somebody giving you a car that already has a damaged fender or, scratches in the side? Because I saw this a lot with Hire Car, where they just put it on the platform and they say, hey, somebody damaged my fender or the side of my car. It's like, well, it was there before it happened. But, how do you know that unless you take pictures before and after the rental? You don't. Okay. And that's, again, we're just talking about core principles of risk management here. There's a various number, what I love about the space is there's a ton of different side industries that's created. There's a ton of different mobile mechanics or mobile check-in services that will do that. There's even some you can build into your app. I think it's via SDK, where, it prompts your renter to take that video before and after. I mean, again, this is just like, tip of the iceberg, but all of these things are doable as long as you go into it with a realistic understanding of the market you're operating in. Because don't forget, insurance has a lot of peaks and valleys in prices across the US. There are certainly the bad cities, and then there are certainly the better cities. And then there's some cities within particular states that are better than others. These are all points of emphasis when you're designing a model to consider.
Yeah, no, absolutely. Absolutely. So, one final question I wanted to have for you is, a lot of my audience is from New York City. New York, as we all know, I started in this industry in New York. It is a totally different beast, has just another layer of regulation, very expensive. What would you say to, Getaround is no longer operating inside New York City, inside the 5 boroughs, but Turo is. A lot of Getaround's people and hosts have moved to North Jersey. I mean, what would you say to anyone who wants to do car sharing in the 5 boroughs or in the New York City area? I mean, how do they deal with this?
That's a great question, and I don't know if I have a great answer. You know, Alex, I make this joke a lot, or anecdote, if you will. I've lost many days in my life trying to insure, you know, fleets, whether they be, you know, transportation network companies, car share, you name it, within the 5 boroughs is just no easy exercise. Because what you have is a state that's run, you know, a lot by 2 specific carriers that, you know, will you know, to stay positive here and just say, you know, not a great risk transfer product. Of the carriers that operate with the most success, I would say in New York City, and success is maybe, you know, exaggeration. Again, you're talking about lack of credibility with paying claims for a cheaper price. And again, I say a cheaper price because that price is also moving up. And that, just a level set for your audience, the price for the substandard, you know, insurance that might pay your claims maybe is going from a place that was already pretty high to now even venturing into the category of you know, pushing people to their limits budget wise, while also providing a product that might not pay claims. Versus, you know, if you go the standard route, if you go the route of credible auto insurance carriers in New York, it's going to be 5, 7, 10 grand more than what you might be paying with the various programs that exist in New York right now, which are very questionable in their integrity. So it's a difficult place. I'd say it's really, New York and the 5 boroughs are really only for the tried and tested operators who have the overhead to deploy there. Because I look at it as, you know, I sit in California where, you know, we've got our own state specific issues, but when, you know, let's say start with homeowners, you know, talk about employment practice liability. I mean, there's a lot of things in California that need fixing. Carriers that successfully write accounts in California, for example, are subsidizing California with all the other states they do better in. Okay. When you've got New York, you have to take that kind of approach from a operational perspective. More than likely, you're going to have to subsidize either your premium, your costs, or any number, maybe even just your lease, with your success in other cities, because it just really is a tremendously difficult place to get insured. Arguably, probably the most difficult place to find auto liability and auto physical damage in the world. I would say that's not an exaggeration. And it's a multitude of items, whether it just be a monopoly that some current carriers own and are really enforcing in the city, legacy kind of medallion-based carriers in that you know, capacity, and we'll get to brass tacks too. The loss history of livery services in New York is not good.
Right.
It's really, really bad. And it's you know, it's not just quality of drivers, it's how condensed and pushed together everybody is. You can make a pretty educated guess on how loss history will be, especially for auto physical damage, which would just be, you know, fender benders, you know, no bodily injury, okay, essentially, no liability, just the cars are damaged and we're repairing fenders, we're repairing X, Y, and Z. Those costs in New York City are tremendous. And by the way, throw into the fold more expensive vehicles. I mean, I don't have the numbers in front of me, the inflation of the cost of new vehicles, but they're pretty significant, especially when you throw in the cost of a new EV, which a lot of models like to run off of as their car share platform. You know, nothing against those models. It's just that the data and analytics that an insurance carrier has, like, throw out New York as being a really difficult jurisdiction. You've got vehicles that have batteries that are not, you know, in other words, the percentage of time those vehicles are totaled is far more frequent. So you've got total losses way more often than you've got for regular ICE vehicles, you know, and I'm not making any comments on EVs here at all and their sustainability, because you know, for lion's share thing, it's very cool, very innovative. I love that many cars are moving to a hybrid system. But, you know, these are all complicating factors kind of in the lens of where we are right now as a society, kind of, you know, culturally bringing on EVs, but also, you know, we got to juxtapose that against a really difficult environment in New York, really, really heavy claims and lack of data behind, you know, EVs, and not to mention the different type of mechanic you need to sometimes repair, say, a Tesla.
Sure.
You know, this use case might not apply to, say, like a Chevy, because, you know, some of those EVs or Chevy are, you know, $30,000. We're not talking about say 60, 70, $80,000 Model Ys or the like. So New York is tough for a lot of reasons, and I think like the reason I brought up those little caveats is I think it's popular to make that difficult, operation to insure in New York even more difficult with recent trends. Going back to ICEs is going to make that process easier, but even if you do that, it's still a difficult battle in New York.
Yeah.
So New Jersey is the trend has been a little bit. Let's move Pennsylvania, maybe New Jersey, but those states are kind of like Texas lately from California. You see a lot of the California folks have moved to Texas. What has happened to Texas? The rates for insurance in Texas have skyrocketed since that happened. Okay, since 2022, I think Texas rates are up like 35%. Okay, is that probably a combination of bad drivers from California, and that might just be me being personally resentful about people driving here. But also, you're also condensing more people within city limits of Houston, Dallas, and so on and so forth. There's going to be more accidents. So, to finish my analogy, what we're seeing in New Jersey and Pennsylvania is similar. Is that those are Pennsylvania's got a lot more rural areas, so it's being spread out, but you're seeing those claim trends sort of translate or sort of just ebb over a little bit into the states that the risk is moving into. Maybe they've got a better trajectory because they've got more options for insurance, but New York is a regulatory nightmare, a claims nightmare, and quite frankly kind of a monopoly from an insurance perspective. So it gets really hard to vet and do your due diligence on your insurance because you've only got a couple options and none of them are great. You don't have anybody else to really press those folks, to be honest, or to improve their pricing or do anything other than, hey man, take it or leave it. And that's not an easy message to get when you're paying $55, $65, $7,500 a car per year.
Yeah. The economics of it at that point just kind of, it starts not looking great from that standpoint. Yeah. So, well, hey, Ed, this was awesome. I don't want to take too much of your time today. Thank you so much. This is really informative. Is there any way, what's your website? Is there any way, I'll include your information in the description of this video, but feel free to plug your website or how, would be best if people have any follow-up questions with you.
Yeah, I mean, I'm somewhat embarrassed to say this. I don't necessarily have my own website. I mean, you could check out our Hub Shared Economy page. I don't have the link for me, but I can send it to you. If you type in Hub International Shared Economy, it should show up. Otherwise, you can find me on LinkedIn, which I'm a little embarrassed to market that, but that's it is a website and it is someplace you can find me in my contact information. Always happy to take any solicitations. What do we do? I'm always happy to hear what's going on too at different parts of the country. So happy to help where I can. And if any of your listeners need a leg up or some assistance or just maybe some therapy, happy to talk.
Yeah, everyone needs a little insurance therapy on occasion. Awesome. Well, hey, thanks for your time, man, and we really appreciate it.